Welcome to SB Talks. Today is Tuesday, March 11th, and I am joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing the recent volatility in equity markets, the evolving US trade policy, and looking beyond the sentiment to consider the fundamental health of the US economy and the world more broadly. Welcome to all our listeners. At the time of recording, we're coming off quite a volatile night. The S&P 500 is down 2.7%, the Nasdaq down 4%. That sees the S&P off about 8% from mid-Feb highs and the Nasdaq almost 13%. Volatility's obviously been fired up by a rapidly evolving policy framework out of the White House, particularly around tariffs. How are you reading what you're seeing right now?
Yeah, I think part of it's due to the tariffs, but then we've had tariff news on and off since the 20th of January when Donald Trump was inaugurated. So I think, definitely there's been a lot of uncertainty, particularly with the on-off tariffs.
We're sort of round 2 or round 3 of
So I think that's definitely not helping things. So we track a thing called the Trade Policy Uncertainty Index, which monitors news flow, and that's the highest level it's ever been, even higher than during 2018 in the first trade war. So that's certainly not helping things. But I think it's broader than that. There's a couple of other things at play that have caused some market jitters. The first thing is some soft economic data coming out of the US that has people questioning the US exceptionalism trade that we've been talking about for some time. There's this.
Well, maybe unpack that a little further if you can.
Yeah, so there's this thing called the GDP Now. It's a nowcast prepared by the Atlanta Fed economics team that basically aggregates a lot of US economic data into what they call a nowcast, which is a pulse on how the US economy is traveling. And they've calibrated it to kind of say, well, what's the expected GDP growth in the current quarter? And that's flipped from being about 2.3% annualized GDP growth in Q1 to negative 2.4%.
Right.
And so that has a lot of people going, ooh, recession risks.
Yes, obviously a certain degree of caution around any individual data point and something like that. But it's sort of in an environment where we've got a lot of noise, it doesn't take much to get people a little bit more concerned. Yeah,
so there's that. And so people are using the R word, recession word. So I think there's that's playing on investors' minds. There's obviously the trade policy uncertainty. And then I think there's this... the Mag 7 obviously had a very strong run. We've had Q4 earnings season where they've produced generally good results, slightly better than expected in aggregate. But take NVIDIA, for example. It beat earnings expectations and revenue expectations, but slightly trimmed its sort of forward growth outlook. Yeah. And so I think the market's now, sort of taken a bit of a hammer to some of those growth tech stocks. And they've sort of unwound some of the recent gains. So that's why the Nasdaq, you talked about the Nasdaq being down more than the broader market. I think that's playing into that, just taking some of that froth or that momentum trade out.
So we talked a lot on this podcast over the last 18 months or so about the Magnificent Seven and how they've grown at multiples significantly more than the rest of the market. As some of that froth comes out, as you describe, it's not that they've delivered poor results, it's just that the market is expecting and wanting exemplary results, and they're not quite getting to the marks to potentially justify just how far their prices are run. So we are seeing probably some profit taking in those names.
Yeah, and as I mentioned, the momentum trade where people buy stocks that are going up. So they're getting on to this sort of idea that these things will continue to rise, and when that no longer happens,
we know that
can reverse very quickly.
The momentum trade is a double-edged sword.
That's right.
And it moves
so you
quickly.
can get negative momentum now. So we're seeing a bit of that as well. So I think it's those three things. It's the trade policy and economic policy uncertainty coming out of the US. It's the recession fear, and it's the unwind of the momentum Mag 7 trade. So
unwind, albeit coming off an incredible run for the market more broadly and particularly for those names. So as we talked about before here, there would be an expectation, certainly in the first quarter, maybe the first half of this year, that we see some correcting given how hard that they have run. I might start to work through some of the other things that you've discussed there. Let's talk about I guess, the potential risks of a recession. What you see, we talked about one data point there in terms of that GDP pulse, but how you are seeing the economy more broadly, how much of this current volatility is sentiment driven versus deteriorating underlying data?
Well, I would say at the moment, most of it's sentiment driven.
Yeah.
We know sentiment can drive short-term moves in markets. And, when we look through a lot of the noise at the US data, it's still pretty good. So let's take the GDP now numbers going from positive to negative. What drove that? One of the big things was the surge in the trade deficit in January. So it was the largest trade deficit in history, monthly trade deficit in US history, and because imports surged 12.9%.
Let's talk about why that is the case.
Well, I think it's obvious that a lot of people are trying to get ahead of the tariffs and stock up on inventory before the tariffs came in. So I think you have to discount that. So that was a big part of the GDP now number going from positive to negative, was that sort of net exports number. There was also some weak consumer spending data in January, which some people are suggesting is due to unusually cold weather. So there could be some weather effect on that. So they're the two things that really move that number around.
But that's an individual number. If you step back from that and look at just, I guess, you've talked, for example, in your investment outlook about some of the underlying tailwinds that are driving the economy in the US. Do you see many of those having changed?
No, I mean, we got the non-farm payrolls report last Friday night, about 150,000 jobs created. The 3-month average is around 200,000. That's still strong employment growth. Unemployment ticked up a little bit from 4 to 4.1, but it's still basically full employment in the US. Yeah. So that's a tailwind, that's positive. People are still getting jobs. Now, we can argue about DOGE and government layoffs, but they're still a fairly small part of the overall employment picture in the US.
Yeah, there's a question, I guess, as a second order effect as they reduce that spending, how it plays out. But really, there's just not enough data there to have any sort of scientific outlook on it.
Not yet. So it's something to watch. But at the moment, the US labour market is strong. We have the ISM manufacturing and services PMIs, pretty good. So that's businesses still saying things are fine, are growing, expanding at the moment on average. And then you have, some of the other tailwinds that inflation, it's been a bit patchy, but it's generally come down and wages are still pretty good. So people's purchasing power is improving. So there's a lot of the tailwinds that we've discussed previously that are still there. The big question mark is, does that change? Do we get a more significant slowdown this year because of some of this uncertainty? Do businesses stop investing or slow hiring because they're uncertain about the sort of economic policy backdrop and the trade concerns?
Yeah, so if we ended up in, let's say, it's hard to imagine it, but a continuous cycle of on-off potential tariff policy, it's going to have an impact on a whole vast array of industries. As one example you gave is sort of the automotive industry, where North America, the three countries are intertwined in that production line.
Yeah, I mean, they're heavily intertwined. So, Donald Trump he likes to talk about the US auto industry.
They're his voters.
They're his voters, his poster child, and he wants to strengthen it. But the reality is that a lot of parts come from Mexico or Canada. And things like, an engine part may be made in Mexico. The part gets sent to the US to get put into an engine. The engine goes back to Mexico to get put in the car. So there's the flow of goods or partly made goods across the border frequently. I read somewhere that things can go across the border 7 times before it gets into the final car product. And if you had tariffs at every step, that's just very destructive. Completely impractical. So I think, we do have to look through a lot of the noise and say, okay, it's creating a lot of uncertainty. At some point, that uncertainty will have to subside because there will either be a new US-Canada, Mexico agreement, USMCA, which is due to expire next year.
So that we spoke about this before, and you sort of projected that a lot of what's happening right now might be just about setting the foundations for how they come to the table on that deal, and obviously Trump's seeking for a better deal.
Yeah, I think they'll have to come up with a new deal. And so, yes, definitely there's some positioning ahead of that to try and, ensure, the US are trying to obviously bully Canada and Mexico to get a better deal. There's the pretext of fentanyl and immigrants, but I think that's, to some extent a bit of a furphy.
Particularly on the Canadian side.
So I think there will be a deal at some point there. There has to be. And... so I think, and then there's this whole thing about reciprocal tariffs. So, we probably won't find out more about that until April the 2nd. That's a sort of a key date for that. But I think that's the direction in which, the US is trying to make trade fair again, to use Donald Trump's terms. He thinks that, the US has been exploited and trade have been taken advantage of, and his effort to try and, improve that is through, potentially this reciprocal tariff arrangement. But it's very complicated because it's product by product and country by country.
And there's even been mention of potentially incorporating things like general sales taxes, value-add tax in that tariff.
Yeah, and I think if all of that came in, then the effective US tariff rate would go up about 10 percentage points, which is quite substantial. I think the average tariff kind of coming into this year was about 2.5-3%. Right. So that's a big increase in the average tariff rate. And that would have a price impact. So that would probably lift inflation by about 1%, but it's probably a one-off. And it probably would also have a growth impact because, of some of this uncertainty and things like that. So there is I spoke about it in the latest monthly report, this sort of stagflation light risk that you could have inflation going up and growth coming down at the same time, which puts the Fed in a very difficult position. Which one do they focus on, the inflation risks or the growth risks? And at the moment, the market's more leaning to the growth risks. So we've seen another rate cut priced in by the end of this year from the Fed. So there's now 3 priced. It was 1.5 not that long ago. So
a lot might depend there on what's happening with the labour market, which is, as you said before, been very strong. But if this continues to play out and starts to have some more Main Street weakness, which flows through to the employment numbers, then the Fed's probably balances their hand a little bit differently.
Yeah, and I think the other thing that spooked investors, particularly overnight, was this comments over the weekend, from Treasury Secretary Vincent talking about the detox needed. Yeah. The US has to wean itself off government spending, and Trump really refusing to rule out a recession, maybe a consequence of some of these policies. He talked about China playing the 100-year game, and so maybe he does have a view on a sort of longer-term transformation with some short-term pain.
Well, what's your take on that? So if we, you've set the scene there that we still have a lot of strong economic fundamentals underpinning that economic story, but you always, in your outlook, had sort of said that the X factor was a major escalation and a tariff war essentially breaking out around the world. How much has that possibly gone from being at the periphery to being more of a central scenario that could play out? And I respect that obviously there can be no absolutes on this.
I think when things are changing, so frequently, it's hard to know. It's not my base case. I still think that the US will come to some sort of trade deals with various, key trading partners like Mexico, Canada, European Union, etc. I think there are, unfortunately, some things like the steel and aluminium tariffs, which are due to come into effect this week, which will affect Australia. We probably won't get an exemption from those. So, I think definitely tariffs are going up. It's just the extent to which they go, from that roughly 3 to that, potentially
could be 10.
10,
yeah.
Additional 10,
yeah.
13.
Your base case, though, is sort of still one where you think that we are heading more towards probably trying to negotiate a new deal rather than just all out.
I think it has to happen at some point. The uncertainty will subside. There'll be we will know what the tariff regime looks like. We mightn't like it, but we'll at least know what it looks like, and businesses will then be able to plan for the next 3 or 4 years of the Trump presidency.
Yeah. Well, it's interesting. We look at the Trump presidency. We're obviously very very early on in sort of Trump 2.0, and comparing and contrasting. There was lots of noise and lots of uncertainty in the prior administration, but the sequencing of how certain policies got rolled out was different, and obviously, and we've talked about some of the, as you described, the sort of the pros and cons, the vegetables versus the sweets. This time we're getting all the pain up front without any of the sort of sweeteners, at least yet.
Yeah, so my expectation, as a heavily caveated that things can change, is that at some point we'll get some certainty around tariffs. There'll be some trade deals negotiated, and at least some of that uncertainty will subside. And then, perhaps later in the year, we'll get an extension of the Trump tax cuts, which is something that they're talking about, and potentially, no taxes on tips and state and local tax deductions, and potentially, they're talking about potentially having tax deductions on interest on your car loans and things like that. So there could be some of that sugar hit later in the year. And deregulation. Definitely that deregulation is the other thing that I guess people were excited about. So that's ongoing as well.
And I guess just overall painting a picture there where we just need to keep a somewhat balanced outlook here, as sort of unsettling as it certainly is right now. It's not capitulation point by any means.
No, absolutely. And I think we've spoken on the call before about how generally it doesn't matter which politics doesn't necessarily affect the real economy and corporate earnings that much. You can go back and look at, which was better for markets, a Democrat or Republican president, and it didn't really make that much difference.
Probably easier to say 4 years down the track rather than where we're possibly sitting right now. But I guess important to take that broader perspective. And also worth, I think, highlighting while we go through these times why we build portfolios the way we do, and what buffers that we put into portfolios that we expect to help limit us. The portfolios aren't, for example, 100% NASDAQ. There's a lot of other pieces in there, and some of them are designed to pay off for us when some of those areas are not running as well.
Yeah, I mean, people question why we hold government bonds in the portfolio given the yields are so much lower than some other types of bonds and other types of assets. Well, this is why we hold government bonds in the portfolio, because last month they paid off. Bond yields have come down from almost 4.8 for the 10-year in the US to 4.2. So bond prices have gone up, and that's happened at the time that equity markets have been softer. So government bonds have helped.
They've done their job.
We've obviously have a big chunk in alternative investments and hedge funds that can buffer portfolios. European stocks have done quite well. Maybe not so much last night, but year to date they've done a lot better.
So part of
cheaper markets.
Cheaper markets, a bit of a rotation. Also, a little bit of this story around is Europe going to have to arm up in terms of defence and go it alone is playing out there. So it's worth, when looking at a portfolio, not just fixating on sort of the headline or some of the headline equity numbers.
Yeah, and we continually look at what's the economic fundamentals, corporate fundamentals. Obviously sentiment's weak, and that can often be a good counter-cyclical indicator. So if things got really weak and valuations got really cheap, then maybe that would be a good time to buy. So we're constantly looking at all these things and trying to filter out a lot of the daily noise.
Wonderful. Look, we are very conscious that for a number of our clients and investors at times like this can be unsettling. So we please encourage you to don't hesitate to reach out to your advisor. Don't hesitate to contact Nick or myself. We're happy to answer questions, but we are here trying to cut through the noise as much as possible and find the right long-term positionings for client portfolios. Thank you for an excellent run through today, Nick, and thank you to all our listeners.